feel the fixed assets question in the paper is usually the one you guys stress about the most, and I'm not always sure why, because it is not that difficult. Okay. You just need to keep in mind that you need to have separate calculations for, first of all, your different types of fixed assets. And then also you must have your old assets, your new assets, and your disposals all separately. Because if you do your calculations separately, it will be so much easier. So I actually wanted to open a Word document real quick to do calculations. No, not Outlook, Word. There we go. Let me just close this. I didn't even use this. There we go. Okay, so I want a Word document for all of my calculations, and then I want to get my fixed assets question back. There we go. So we are going to now use the information provided for the financial year ended 31 May 2018. So in other words, I want to go here and I want to write in my calculation that my financial year started on the 1st of June 2017. And then I just want to zoom in real quick because otherwise you're going to struggle to see what I'm doing. Okay, so started on the 1st of June and then ended on 31 May 2018, right? So it's always important to just keep track of your financial year. If you want to, you could even do it this way, and then you draw a timeline to see what happened here during the year. Okay, so here's my timeline. Started and ended 31 May 2018. Okay, right. So they want us to fill in the missing information using our fixed assets register. So remember, you're going to look at each one of them separately. So starting with land and buildings, they are saying that you had at the beginning of the year costs of 6 million rand. Then it says here with information B that you paid 882,000 Rand for the building of new offices and the repairing of windows. So the total that you paid was the 882. But of that, only 610 was for the new offices. The rest was for repairs and maintenance. Okay, so for repairing windows. So the additions in your land and buildings is only that 610,000 Rand, not the repairs. We don't include that. Okay, right. Next up, we have computers. So you started with some computers and then you had accumulated depreciation. So computers. Computers had opening balances for our cost, 108,000. And then for our accumulated depreciation, we then had a cost of, or an amount of 95,000. Okay, so you have your cost and you have your accumulated depreciation opening balances. So on the first day, then they want you to now calculate the depreciation for the year. So we'll go to the additional information. Information C is about our computers, and it says that 3 computers were bought on the same day. So in other words, you have owned all 3, the computers included in this cost. You have had that for the same number of years or months then. Depreciation is 33.33% on cost. So 33.3333 on cost. These computers are expected to last another 2 years. So in other words, you are not planning on disposing of these computers for at least the next 2 years. So what they're saying is that this is the computers that you had for the full financial year. You didn't dispose of anything. You didn't purchase any other computers. So this is what you are working with. And these assets, these computers, you have to calculate depreciation of 33.33% for the full financial year because you owned these assets for the full financial year. So 108 times 0.333333 because 33,33333. And then you will see that that gives you 36,000. So they are saying that this should then be your depreciation for the year. But you know that you always need to ensure that if you now record and post this depreciation, that your accumulated depreciation is then not more than cost. And that is the case. So your cost is 108,000. If you now record and post this depreciation movement for the year, your depreciation, accumulated depreciation at year end will be more than cost. You know that you may only write off an asset until it reaches a carrying value of R1. And your carrying value on the first day of your current financial year was 13,000. Therefore, you cannot write off 36,000 Rand because then this asset's value is going to go into a negative value, and you can't have a negative fixed asset. You either have the computers or you don't. Therefore, your depreciation is limited to 12,999 Rand, because that way, by the end of this financial year, you will be carrying these assets at a R1. But that is now also for one computer. You had 3. Therefore, you can only write off depreciation of 12,997 Rand because you had 3 computers. And each one of those computers must have a R1 value or more in your books. Okay, so that's why for this one, it's 12,997. So 12,990, please squeeze in there, 97. So it's 3 Rand only because you had 3 computers each now with a R1 carrying value. If we don't give you the details regarding how many computers or whatever, you're then just going to work with R1 value. But because they now told you specifically this is 3 computers all purchased on the same day, then it means each one of them must have a R1 carrying value. Okay, so that was it for your computers. So your accumulated is now opening balance plus depreciation for the year, but they didn't ask for that. Equipment. So here we go. Equipment. And just equipment. We had an opening cost of 1,250. We had opening accumulated depreciation of 222,500. Okay, and then we had a carrying value of 10275. Oh, carrying. There we go. So that is what we currently have. They are saying that you also had additions. So in other words, these are your old ones, and then you also purchased new ones. The new equipment had a cost of 172,500. And then they said that you had no disposals. Lovely. Okay, so let's move on to the additional information on equipment. Says that the additional equipment was purchased on the 1st of Feb 2018. So remember, your financial year ended 31 May 2018. So somewhere here within your financial year, on the 1st of Feb 2018, you purchased new equipment, and the new equipment had a cost of 172,500. So in other words, you started with some equipment. Yes, that's correct. So you had some equipment at the beginning of the year that you didn't dispose of. So you had it for the full 12 months. There we go. But then you also had some new equipment that you purchased on the 1st of Feb. So you only owned it for Feb, March, April, May. So only for 4 months in your current financial year, as opposed to the 12 months that you had your old equipment. And that's why you need to split the calculation, because one thing you had for 12 months, the other thing you only had for 4 months. So your old equipment's depreciation for the year is still calculated on cost, but now 10% times 10%, and you earn this for the full financial year. Whereas the new one, the depreciation at 10%, but only for 4 out of the 12 months. So we had the 125 times 10% for the full year, so your 125,000. And then the other one, also at 10%, but only for 4 out of the 12 months, so 5,750. So therefore, the total depreciation movement for your equipment is the 5,750 plus the 125,000. So 130,750. There we go. So that is what you have to show in your note now. That is your depreciation for the year. So 130,750. 130,750. Okay, so if I ask you calculate the total depreciation on equipment, that is what I want. Next up, we have vehicles. So once again, we started with some vehicles. So vehicles, you had an opening balance for the cost, and that was 2.1 million. Then you also had an opening for the accumulated depreciation, and that was 800,000. Okay, there we go. Then they said that you had a disposal, but you didn't have any additions. So in other words, you didn't have all of this for the full financial year because there was a disposal. And we don't know any of the details regarding the disposal, so we will go to the additional information. Right, so it says that, first of all, your depreciation is 20% per annum using the carrying value. And it then says that one of your vehicles was sold for cash at carrying value on the 31st of December. So for your vehicles, let's make it another color so that we can keep track of what's going on here. Okay, so this was your equipment. Now they're saying your vehicles, you started with some vehicles at the beginning of the year. And that was 2.1 million. So 2.1 million. Oh, I like this color. It looks cute. Okay, so 2.1 million. And that had already accumulated depreciation as well. You then own some of it for the full financial year, but some of it you sold on the 31st of December. So 31st of December, 2017, you had a disposal, and the disposal's cost was 176. Okay, so can you see that you didn't own, just wait a moment. Right. So we didn't own the full 2.1 million for the full financial year because we disposed of some of that during the current financial year. So you can therefore not now do one calculation for the full year. You need to split your calculations. So that's why I will have here my old ones. So in other words, the ones that I had for the full financial year. And then I will have my disposal. My disposal had a cost of 176. And it had accumulated depreciation on the 1st of June, so the first day of the current financial year, of 128. Right? So that means that I cannot have the 176 included in my depreciation calculation for the old ones. So I'm going to remove that because I didn't have it for the full year. And if I remove the cost, I also have to remove my accumulated depreciation on that disposal on the first day. So 21 minus 176. And yes, I know they did do this calculation, but because they did give us the depreciation for the year, but I'm going to do it anyways, right? So there we have the cost of the vehicles that we owned for the full financial year, and we're going to do the same with the accumulated. So this is the accumulated depreciation on the vehicles that you have here. So you have just removed now the disposal because you're going to do that calculation. You're going to do that calculation separately. So the old vehicles you had for the full year, and depreciation is calculated on 20% using the carrying value. So the carrying value here is your cost minus your accumulated depreciation on the first day of the current financial year. So it is our 1924 minus the 672. So there we go, 1.252. That is our carrying value. So that is the value that we will use to calculate depreciation on the assets that we own for the full financial year. So times 20%. So 250,400. Right? Because they said it is at 20% using carrying value. Then this disposal over here, we first need to now also calculate the carrying value so that we can calculate our depreciation. And we sold this vehicle on the 31st of December. So 31st of December, we started on the 1st of June. So we had it for June, July, August, September, October, November, December. So we owned this vehicle for 7 months in the current financial year before we dispose of it. So 7 months. Righto. So the carrying value is my cost minus my accumulated depreciation on the first day. So that's 48,000 times by 20. And then for 7 out of the 12 months that I owned this vehicle in the current financial year. So it is 48 times 20% for only 7 out of the 12 months. So 5,600. So in other words, your total depreciation on your vehicles is the old ones plus the one that you disposed of because you use it for a few months in your current financial year. So it's the old ones that we had for the full year and then the one that we disposed of. So that is your total depreciation expense for the year. But then the disposal that you have to remove from your books. So see, like I said, they already did that one. Just wanted to show you how they got to that answer. For the disposals, we have to remember that disposals are at carrying value. So additions at cost, and then disposals are at carrying value. Carrying, should have just written CV, at carrying value. So that means that I now have to calculate, I have the carrying value at the beginning of the year, that's a 48. But I now have to calculate my carrying value at date of sale. Did I not type that correctly? Yes. Okay, at date of sale. And that is my carrying value at the beginning of the year minus the additional depreciation written off for the usage of 7 months in the current financial year. And that is 42,400. So this is the amount that you now have to remove in your note over here. So over here, you are going to remove your 42,400. 42,400. Just keep in mind that whenever it is something that we are removing or that's going to decrease the carrying value, it has to be in brackets. Okay, then comes my accumulated depreciation at year end. So just think about your accumulated depreciation account. I always say it's easier to draw the T account when you're doing this, but just a rough draft because you won't have enough time for like a proper account. So accumulated depreciation on vehicles is the one that we're looking at now. So we started on the first day of the current financial year, we started with the balance brought down. Then we had to on the date of sale, on that disposal date, we had to calculate and record depreciation up until the date of sale. Then we also had to, at year end, calculate the depreciation on the assets that we then had, the vehicles that we had for the full financial year. And then we also had to remove that accumulated depreciation on the asset disposed of. And that then will give us our closing balance. So we started with our vehicles. We started with accumulated depreciation of 800,000 Rand. So that's the opening balance. It includes the disposal because remember, we're only going to remove the disposal at a later stage. Then for the current year on that disposal, we said that we have depreciation of 5,600 that we then calculated and recorded. So now we are posting it. There we go. Then we also had some vehicles for the full financial year up until year end, and we calculated depreciation on those. Then we have to remove the accumulated depreciation on the asset disposed of, keeping in mind that we started on 128,400 and then we calculated for the current year 5,600. So in other words, we have accumulated depreciation on that disposal of 133,600. Oh gosh, where's my 3? There we go, 133,600. Okay, so I removed the cost from the cost account, so I also have to remove the accumulated depreciation from the accumulated account, so 133,600. So now I can calculate my closing balance easily using that information. So it's the 800,000 opening balance plus the depreciation on the disposal up until date of sale, minus the accumulated depreciation on that disposal up until the date of sale, plus my current year's depreciation for the vehicles that I owned for the full financial year, or at least up until financial year end. That's 922,400 that we have there. So that is then what will go into your note here. So 922,400, remember it must be in brackets. Okay, so that is a fixed assets note with a little more transactions than what we have been